Today we will study important concepts of business management related to strategy and strategic financial management.
Welcome to Chapter 8, Corporate Reorganization. Defensive strategies. A capital reconstruction scheme is a scheme whereby a company reorganizes its capital structure. Procedure of designing a capital restructuring scheme. 1. Calculate what each party's position would be in a liquidation. 2. Assess possible sources of finance. 3. Design the reconstruction. 4. Assess each party's position as a result of the reconstruction. 5. Check that the company is financially viable. Exit strategies for a venture capitalist. Sale of shares to public or institutional investors following a flotation. 2. Sale of shares to another company. 3. Sale to company itself or its owners. 4. Sale to institution management. Downsizing. Divestment is a proportional or complete reduction in ownership stake of an organization, e.g. Downsizing. Demerger. Sell-off. Liquidation. Spin-off. Management buyout, MBO, privatization. Reasons for divestment: to concentrate on a particular part of business. Selling a loss-making unit. Liquidity problems. Selling a subsidiary with high risk. Selling a subsidiary at profits. Provide an exit route for investors. Remove value gaps to avoid takeover. Demerger is splitting up of a corporate body into two or more separate and independent bodies. Sell-off is a form of divestment involving the sale of a part of a company to third party, usually another company. Liquidation is extreme form of liquidation where the entire business is sold and funds are distributed to shareholders in their proportion. Management buyout. MBO. Management buyout is the purchase of all or part of a business from its owners by its managers. Management buyout. MBI, where purchase of a business is made by group of managers from outside the business. Spin-off. A new company is created whose shares are owned by the shareholders of the original company which is making the distribution of assets. Management buyout. Possible reasons for MBO. All reasons of divestment. Best offer from management. Sale can be arranged quickly. Group can still maintain relations. Success factors of MBOs. Advantages. Favorable buyout price. Personal motivation and determination. Quicker decision-making and greater flexibility. Savings in overhead costs. Healthy relationship with subsidiary. Questions in evaluating MBOs for investment. Does management have the full range of required skills? Why is the company being sold? What are the projected benefits and cash flows? What exactly is being acquired? What is the purchase price? Is funding available? What are the exit routes? Problems faced by MBOs. Disadvantages: limited experience in financial management. Tax and legal complications. Difficulty in changing employee attitudes. Challenges in deciding the bid price. Need for cash to maintain fixed assets. HR changes, possible loss of key employees, maintaining relationships with suppliers and customers. Going private. A public company goes private when a small group of individuals buys all of the company's shares, possibly including existing shareholders. Advantages. Cost savings, expenses of meeting statutory requirements are reduced, limited number of members. Similar objectives among shareholders. Shareholders are close to management. Protection against volatility in share price. Disadvantages of going private. No trading of shares on the stock exchange. Loss of reputation. Possible reduction in share value. Disadvantages of demerger. Loss of economies of scale. Lower turnover. Higher overhead costs. Reduced ability to raise finance. Thanks for watching.